Most Americans are overpaying the IRS by $22,000 a year and don't even know it. That money could buy top shelf healthcare in Portugal or a full year of early retirement in Vietnam. A secret yet legal hack called the FEIE exempts from taxes your first $130,000 of income per person per year. But if you miss even one small detail, you lose that sweet tax-free gift. So let's walk through exactly how the FEIE works and how you can use it to build a freer, wealthier life abroad. Let's start with the basics. What is the FEIE and why should you care? The Foreign Earned Income Exclusion, or the FEIE, lets you exclude up to $130,000 in foreign earned income from your U.S. federal tax return. If both you and your spouse qualify, that's over $260,000 of annual income tax-free. I'll talk about what that foreign earned income means in just a second. Yes, this is federal tax we're talking about, the big one. For many Americans living abroad, this exemption can reduce your tax bill to almost zero, especially if you have residence in a zero or low state income tax state. That's money you can put toward travel, a better healthcare plan, a beachfront property in Costa Rica, or just not working as long. So what would you do with an extra $20,000 this year? Drop a comment down below. I'm curious. Now, here's what the FEIE is not. It does not apply to investment income, retirement income, or pensions. It doesn't mean you avoid all taxes. And it's not automatic. You have to qualify and file. But once you do, it's a major key to keeping more of what you earn, which is the ultimate goal, right? So who qualifies for the FEIE? There are 3 boxes you need to check to legally exclude this income from your return. You must earn income from working abroad. This means you're self-employed and living overseas, or working for a foreign employer, or running a U.S. company remotely, as long as the work is done abroad. And remember, this is for earned income, not retirement distributions or investment gains. 2, this is where you work and live most of the time. If you're working remotely from Portugal or Thailand and not maintaining a base in the US, that becomes your tax home. And then 3, you must pass one of the following 2 IRS tests. Number 1, the physical presence test. You must be physically present outside the US for 330 full days in any 365-day period. That's not a calendar year. So you can't just bounce back and forth every couple weeks. Here's the beauty. You don't have to be in just one country. You can slow travel, you can nomad your way across continents, or live in multiple countries. But if you do spend your time in just one country abroad, the next test is for you. Number 2, the bona fide residence test. This one's generally trickier. You have to establish residency in a foreign country, show you've been there for a full calendar year, and prove your ties to that place with a lease, visa, bills, even joining the local gym help. This is ideal for people who want to live abroad in a single place. Think early retirees, slow-mads, or digital nomads who've picked their base. So the big question is, how much can you actually save? In addition to the foreign earned income exclusion, you can add in these other benefits of living abroad. The foreign housing exclusion, which is like the sister of the FEIE, and lets you deduct part of your rent or housing costs overseas. In expensive cities, that can be another $50,000 or more. I'll do a separate video on this soon. Let me know if you want to hear about it. Double tax treaties with 60 to 70 countries around the world that prevent double taxation of your income. And finally, tax residency in a country that does not tax foreign income, like Panama, Paraguay, or Malaysia. If you earn $125,000 a year as an employee while living abroad, have residence in a zero state income tax U.S. state, and qualify for the FEIE, you could owe the IRS nothing. Suddenly you're earning more, keeping more, and living better than you ever could have back home. This is the thrill of living outside of America's borders. By the way, if you want a few more reasons to move overseas, I wrote a 162-page ebook about why, how, and where to move abroad. You can download it for free at the link in the description. Okay, let's summarize this quickly. To qualify for FEIE, you must earn income while abroad, have a tax base outside of the United States, and pass either the physical presence test or the bona fide residence test. Don't forget that the U.S. subjects its citizens to what's called citizenship-based taxation, which means that even if you live abroad 365 days a year forever, you still have to file a U.S. tax return annually. If that sounds like a headache, you're right. That's why we always recommend working with an international tax pro before moving abroad. So who is this FEIE perfect for? Typically, it's remote employees, freelancers and consultants, business owners living abroad, part-time contractors with location freedom, and with the right setup, retirees can take advantage of FEIE in that last category. Just note that if you're self-employed, you still owe Social Security and Medicare. I'm in that boat too, I get it. If you're making above that exclusion cap, more than $130,000 per year, you can still benefit. You'll pay tax only on what's left after the exemption. And with the right structure, you may still owe very little. Okay, here are the top FEIE mistakes I've seen U.S. expats make. Maintaining residency in high-tax states like California or New York that don't even recognize the FEIE regardless. Forgetting to file altogether. Yes, you still have to file. Using the FEIE when the foreign tax credit would have saved you more. And we'll talk about this in a second. And finally, spending too many days in the U.S. if qualifying or trying to qualify for the physical presence test. This is a really sad story. An American from Tennessee, which is a zero state income tax state, came to us last week after he lost $25,000 in tax savings because he returned to the US for his friend's birthday party and didn't account for his total days spent in the country. You need to track your travel days like your retirement depends on it, because it very well may. So this is a question we get often. Should you use the FEIE or the foreign tax credit, which is a credit for all the tax you pay in a foreign country? You cannot use both for the same income. It's either or. So here's a quick rule of thumb for those who become tax residents in another country abroad. If you live in a lower no tax country overseas, we recommend using the FEIE. If you live, God forbid, in a high tax country like Canada, France, or Germany, the foreign tax credit is probably better. Most people spend their best years working for money they'll never get to fully enjoy. This is where working with experts like the Freedom Files pays off. We help you structure your life and income so you keep more of what you rightfully earned and live better. If you're earning income abroad, this FEIE could literally save you tens of thousands of dollars every single year. That's money you keep, compounding, years you gain back, and freedom you feel now, not someday. Want help figuring it out? Book a Freedom Consult and let's map out your lower or even zero tax life overseas. Or take advantage of our free 162-page Retire Earlier and Live Better Abroad ebook on the website. It's the roadmap to a healthier, wealthier, longer life abroad, and really should not be free. If you're ready to stop overpaying and start living, hit subscribe. You're just getting started.